Welcome back to Yuri's Box. In this video, I'm going to talk about TLT, the week ahead. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. So, just a little while ago, something like half an hour ago, we got one of the first data sets, really one of the most important data sets for the week. We had retail sales come in a little bit softer at 0.2% compared to the consensus of 0.6% rise. Honestly, look, I like to dunk on a lot of these data sets, but I think that when it comes down to retail sales, the most important thing you have to remember, in my opinion, is that people spend money. If people have money, they'll spend money. And even if they don't have money, they'll spend money. They'll find a way to spend money. I think that is one of the biggest lessons to remember from the post-pandemic era. And in general, people will spend money. So I would put retail sales kind of in the same basket as initial jobless claims. By the time people have stopped spending, it's too late. Okay, so it's really more of a backwards looking data. Okay, now we had a miss, and of course, markets in general will try to hang on to anything to try and make the pieces of the puzzle try to take shape. We honestly had a mixed reaction just a little while ago. We were closer to basically the rates being unchanged, really. We had a small pop higher just as as this data got released right here. But overall, we are still a little bit lower, and we'll see how how the market decides to spin this data. As well as that, we had the manufacturing index come in lower for the New York Empire State Manufacturing Index. And parts of the index really pointed towards more of the same, meaning what you saw in previous ISM and PMI reports in the month of February, really, is that future orders were down, activity was down, prices paid were up, more of the same. Okay. Now, as far as the week ahead is concerned, we do have some housing data coming out tomorrow, but really the highlight of the week will be the FOMC conference meeting on Wednesday. Now, I've made a video on the Fed, okay, and how the summary of economic projections is really, more than anything, a contrarian view. So, however the summary of economic projections comes out today will just be an indication of how it won't be in the next summary of economic projections, okay? So whatever they're worried about today, they'll be worried about the opposite in 6 to 7 months' time, okay? Hey everyone, welcome back to Yuri's Box. In this video, I'm going to take a look at TLT, the week ahead. If you like this kind of content, consider leaving a like, and as usual, nothing in this video is financial advice. So just a little while ago, something like 40 minutes ago, we had the first data set for the week come out in the form of retail sales, and it came in a little softer. 0.2% rise compared to the consensus view of a 0.6% rise. Now, if you watch my previous videos, you know I'm I like to dunk on a lot of these data sets, and really, the problem with retail sales is that if people have money, they'll spend money, and if they don't have money, they'll find a way to spend money. Okay, so the baseline for people is spending money. By the time people stop spending money, it's already too late. It means something happened and people are cutting back. So I would put in US retail sales in kind of the same basket as initial jobless claims. By the time initial jobless claims turn sour, it's too late. Okay, so it's kind of a backwards looking indicator. And that's basically my interpretation of it. Again, by the time retail sales, whenever or if retail sales turns sour, that'll just be a confirmation that something's already happened. Okay. As well as retail sales, we had the Empire State Manufacturing Index come in lower than the consensus view. And really, what you saw in this report was pretty much more of the same, actually. You didn't see anything new, meaning prices paid was higher. You saw, I'm pretty sure employment was down, future economic activity was down, orders were down. And this is something that, again, going back to the PMI report that got released a month ago, again, it's really just consistent with everything we saw a month ago. Okay, now this is just one part of the big, manufacturing picture in the US. So again, I wouldn't extrapolate too much from the Empire State Manufacturing Index, but again, if you wanted to draw a parallel between that and the PMIs, you could very well do it, because I mean, what you see is more of the same. And again, before you get your hopes up or down, however you interpret the where we are in the economic cycle, I would wait for next week. Okay, where we have the S&P PMIs get released for the month of for this month. And I think that will be really an indication of where things are, because again, really the question you have to answer, in my opinion, is what we saw last month a fluke, or is it something more? Okay, are we in something that is more consistent with last summer, where what we saw from September to March is what I call like the seasonal bump, where you see things look better, people are more optimistic because that's when people travel more, when people spend more because of the holidays, and people get end of year bonuses and so on and so forth. And so again, was that just like a small part, something that was just just passed by, and that we're just going back to last summer? Again, that is really the question you have to answer. As far as this week is concerned, though, you do have some housing data coming out tomorrow. But really what will end up moving, things like TLT, I think, will be the J Powell's press conference on Wednesday with the FOMC. And really, going back to TLT, where we are right now is in a curious position because, again, if you wanted to look into the technicals, which I'm not a fan of at this point of the cycle, you could just say this is like your textbook bull flag. And it's actually being reinforced by the fact that we've held support of the bull market support band in quite a convincing manner. We know it's not just been a wick. We have been here for, well, really about 11 trading days at this point. But again, I'm not a fan of technicals at this point. I don't really feel like it's the time to look at bear flags and bull flags and fib retracements. It's a matter of how the economic data will come out. As long as things continue to surprise to the downside, risk off is still in play. And if the data comes in more positive, then you have to reconsider that as well. Okay. So keep an eye on the bull market support band if we hold support there. If anything happens on Wednesday, just let's see how that evolves. If we just go down and retest the trend line, as I've been pointing out that is a possibility, or just we continue to hold support and then we pop higher. Now, I'm not the biggest fan of events like the FOMC conference for the simple reason that, at best, things like the summary of economic projections that we'll get a new release this month. We get releases in March, June, September, and December. They're really, if anything, a contrarian indicator. For the simple reason that if you compare the summary of economic projections for last year, from March of last year, where things were, okay, the median projection was roughly between 4.5 and 5% on Fed funds rate, okay? And this was still in between the time where we had, sticky inflation, but overall, the last time we had the summary of economic projections before this one was in December. And really, at that point, the Fed had already signaled their intent to at least not consider rate hikes and look towards rate cuts. Okay, so this is really just to add a little bit more context. But as things progressed, you really didn't see much of that disinflationary trend continue, which caused the next SEP to come in hawkish. Okay, so you had basically everybody sticking towards less rate cuts. Okay, as you can see, the dots basically moved and drifted higher. Okay, this is March right here, and here we are in June. In September, because from June to September we had that growth scare, okay, and the disinflationary trend actually resumed. So we had lower inflation and a possible growth scare where we had the non-farm payroll print come out at a big miss in the beginning of August and a big jump in the unemployment rate. So sure enough, in September's SEP, what we had is a significant drift lower for the end of 2024. And also, if I'm not mistaken, for 2025, from June, we had a significant drift lower for the end of year Fed funds rate projections for 2025 in September, because we had that growth scare in August. Okay, what happened after that? Everything started looking better. We had economic data surprise to the upside. We had non-farm payrolls look fine. Okay. Now the composition of the non-farm payroll print, we that can be arguable. Okay, because ever since the summer, and probably between May and June, if I'm not mistaken, we really had non-farm payroll prints come in. The bulk of the gains in the NFPs were really government, healthcare, and education, which economically isn't the best composition for your ideal non-farm payroll print. You want to see, professional jobs, things in the private sector that manufacturing, goods producing, things like that. Whenever you start seeing education and healthcare take the lion's share of the job gains, that isn't typically your best indicator. But in any case, that's how the headline data came out. And sure enough, from September to December's SEP, okay, we had a drift higher from 2024, of course. I mean, we did have rate cuts, granted, but looking at 2025, everybody just started saying, all right, no more rate cuts, forget about it. Or at the very least, saying less, okay? So what I'm trying to say is that, yes, it will move things in the short term. What we see and what will be said on Wednesday will move things. But I'm not too bothered about what will come out in the SEP, which is really what everybody will be looking at with the dot plot. My expectations are really set for more of the same again, and a slightly more hawkish tilt because of what we saw in the University of Michigan and general, inflation expectations rising. Now, I've made the case fairly clear in my previous videos where I've said many, many times that things like anything that asks for people's opinions is not great, for the simple reason that if you're asking for someone's opinion, what you'll get is something that can be easily skewed by political opinions. And sure enough, if I can just pull it up here, I think I have it. It was the zero hedge right here. Okay, so, and this was the beginning of February, but honestly, if you look at even the latest release by the University of Michigan, you've seen more of the same. You see Democrats expecting a terrible increase in inflation. Okay, they're expecting 2022, and you see Republicans expecting basically deflation. Okay, and again, this isn't judging Democrats or Republicans. It's just saying that before Trump got elected, okay, right here, Democrats were, just chilling. They were chilling at 1.5. Then Trump gets elected, and it's Armageddon. So honestly, as far as I'm concerned, I don't really look that much at University of Michigan or any other surveys, really. What I do look at is things like the quits rate, because the quits rate isn't a survey of people's opinion, it's a survey of people's actions and what they're really doing. And actions speak louder than words. If you're not quitting your job and you have the quits rate at cycle lows, now granted we had a pop higher in January, which, by the way, we still had inflation going slightly higher, which, again, look for the next month's release. I wouldn't be shocked by a small retrace of the quits rate. But in any case, the quits rate is much better, in my opinion, at telling you where we are in the cycle, for the simple reason that you have no political noise in this number. If people aren't leaving their jobs, that is all the indication you need on where we are in the cycle. Okay, if we're up here, things are great. and probably a little too great, as this will feed into inflation. But in any case, the economy is not a problem. If we're at cycle lows, that's a whole nother story. So coming back to the FOMC release, because they tend to look at these kind of surveys, I wouldn't be surprised at a slightly more hawkish tilt, especially in the dot plot. Nothing too dramatic. What could skew it to the more dramatic side is, of course, that we've had tariffs, and the fact that they all feel compelled, or at least could feel compelled, to react to all the tariff policies. Okay, so tariffs cause inflation. This is, of course, this is an oversimplification. So therefore, we can't cut as much as we possibly thought. Again, if you have tariff policy, you have University of Michigan and overall consumer expectations for inflation going higher and getting unhinged, I would expect the summary of economic projections to reflect that. And although December pointed in that direction, I wouldn't be surprised if we see something like we saw in the change and the shift that we saw from March 2024 to June 2024. I wouldn't be surprised at all by that. So we have just like the median expectation go higher. Okay, just all of these people that were down here, I wouldn't be surprised if they just drift up. Okay, so if this is December's SCP. I wouldn't be surprised if these guys chilling at 3.3 and a quarter, 3.5, just end up somewhere around 4% or 3.75, something like that. Because again, we have the only thing that they can make decisions on is the only data that they have, and the only data that they have is that non-farm payroll prints on the surface aren't a problem. On the surface, and I stress on the surface, what you have is tariffs, which, depending on how you're looking at things, could easily be painted as inflationary. That is in my view, but I can easily see the FOMC committee, people on the committee interpreting things that way. And inflation expectations, rising. And if you put 2 and 2 together, I wouldn't be surprised if you just see these dots that were here in December just drift higher. And that would just make the dot plot a little bit more hawkish, again, to reflect the data that came out now. And as I've argued in the previous video I made on the Federal Reserve, this would just be the contrarian trade. Whatever they're worried about now, they'll be worried about the opposite in 6 months. Okay. In March, they were confident they could cut. Then in June, they were confident they couldn't cut. Then in September of 2024, they had to cut a lot. And then in December, they couldn't cut. So it's just noise at this point. But of course, markets will trade off of them. How would things react when the things coming down like a TLT? Honestly, I still tend to see bias towards higher rates. I don't see I listened a lot to Neil Dutta, and he describes it as the smoking gun. We really don't have anything, to point towards to say this is definitive evidence that things are falling apart. What we do have is increasing pieces of the puzzle, okay? But they're still yet to come together. And I still believe that is a story for the summer. Now, the summer is rapidly approaching. Things have, time flies. But overall, for the time being, rates, they have come down. But the bias, as far as I can tell, is, we keep looking for a reason for them to be higher. Given that, if you see the Fed have a more hawkish tilt, which acknowledges the fact that, rates can't come down too much, as I've made the case before, I wouldn't be surprised if you actually saw a positive reaction in the bond market, because that would just be like um, the bond market really just saying, "Oh, you're doing what we're doing, and so we're on the same page, and so we can be confident that you're not, messing things up," which would be the opposite of what happened ever since they started cutting rates. Okay, moves went up in the face of a more dovish Fed. I wouldn't be surprised if now we saw a slightly more hawkish Fed and yields be a little bit more accommodative. Again, that is just my speculation. We'll see how things move. We'll see how the Fed reacts. Um, I wouldn't. I wouldn't. I'm not expecting a dovish Fed for the simple reason that the Fed and big institutions, especially big public institutions, are really in the business of reacting to things rather than being proactive. That's a feature of every Federal Reserve Committee. It is not a bug of this particular Federal Reserve. Throughout history, the Fed has reacted to things. Okay. It never tries to anticipate things. It's just a matter of reacting to the latest data set. Given the fact that we had benign, non-farm payroll prints, the unemployment rate is still relatively low, though we've seen things pointing towards a rise in the coming months, but this is still on a development story. But again, you can't really make a case either way just by looking at the data that came out now at the superficial level. I'm not expecting a dovish Fed. I'm expecting more of what we saw in December. So again, indication that more of the same. So tariffs, we have to consider tariffs. We have to consider incoming policy. More of that. And again, I expect the bulk to remain where it is now, and possibly these 5 dots to drift higher, whoever these guys are anyway. And again, I think if we get that, you could see yields on the long end of the curve react in a positive manner, just because the market would interpret that as the Fed, being on the same page as the market. Okay. But again, we'll see. We'll see how things move. But again, the most important thing that I want to stress in this video about the FOMC is that in the long term, it doesn't really matter what the SEP says, because at best, it is a contrarian. You have to treat it as a contrarian trade, really, because again, whatever they're worried about today, they'll be worried about the opposite in 6 months. That's what the story of the Federal Reserve is, simply because the only thing they do is react. So when you're reacting to things, you're continuously flip-flopping. And again, however this SEP comes out, it'll just be an indication that, they'll be worried about the exact opposite in 6 months. So as far as this is the FOMC coming up, I don't think I'm really missing much. We do have initial jobless claims as every other week. Consensus for this for last week's print is 224. As I remind everyone in my previous videos, the line in the sand for initial jobless claims, as far as I'm concerned, is really the 215 to 220 level. So whenever you see anything between lower than 215, you can generally make the case that unemployment rate is likely to move lower. If you see them stay between 215 and 220, it's status quo. And if you see initial jobless claims be above 220, that is just an indication that you're likely to see a higher initial unemployment rate at the next non-farm payroll release. So again, keep an eye on that. But apart from that, I don't really see anything significant for this week. What you really will be looking for is next Monday's release for the S&P manufacturing and services report, because again, what we're really looking for is an indication of a confirmation or a complete rebuttal of what we saw last month. Are we confirming or are we dismissing February? That is what I'm looking for, and but again, that is next week's. That'll be for next week's video. So really, what you have to pay attention for this week really is the FOMC conference. I expect it to be a nothing burger, and if you really do see anything, it'll just be more of the more of the hawkish side, given the fact that we did have inflation expectations in consumer surveys go up. I won't repeat myself, my views on that. And also the tariff talk. Okay. I expect them to have a slightly hawkish tilt. And just to add more on what we saw on December. So keep an eye on that. I'll keep you guys updated on whatever whatever's going through my head. Okay, and I'll see you in the next video. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.